Private credit funds are gaining traction as investors look to diversify as these volatile times continue. To get us across the space, Mark Sherwood from iPartners joins us now. Hey, Mark, nice to see you there. Thanks for joining us. When we think about private credit, I mean, where's the real appetite coming from?
Yeah, we're very active, I would say, Nadine, and good morning, with the non-bank lending sector in particular. Particularly for us, it's about non-bank lenders that already have proven business models. That is, they're continuing to grow very, very well. We're not talking here about buy now, pay later, but really talking about groups that do extensive credit work on all their borrowers before they essentially lend. So that space has been very active for us both last year and the start of this year. We've kicked off with more deals now, really funding those non-bank lenders that have got proven, extensive, strong credit processes in place. That becomes quite a good risk reward for an investor.
Okay, and so this is presuming, or this is sound even if we do see further slowing in the economy, because I'm thinking about small businesses suffering as people stop spending.
Yeah, it's something we're really aware of and really spending a lot of time on, because you're exactly right. There's no doubt the momentum has turned. It's coming through the data. The household sector is already under pressure. There's lag that's coming through in the data that we've seen in the last month or so. So there's no doubt that that's going to put pressure on small businesses. That said, it doesn't rule out the sector. For instance, interestingly, we're doing a funding deal for a lender to small to medium businesses right now. But there's deep security in the deal from our point of view, because we're taking a full security position over the actual loan book. So even kind of if that business analyses a small to medium business wrong and has an arrears or perhaps in a default situation, it ends up being a very, very, very small piece in an overall investment position that we've taken.
Hey, Mark, is there much interest or appetite for equity right now, private equity?
Yeah, private equity is very active. We're actually involved right now in a private equity capital raise for a business that's sort of valued in the $30 to $40 million category. So this is a business that's quite a fascinating one. It's a business called Unyoked, which has already proven a strong brand in Australia as well as offshore. They provide cabins on private land for people to do short stays in unique kind of bush locations. So really fascinating type of business. Obviously a business that grew through COVID, but is proving to be in demand far and beyond COVID. And so it's not a fad by any means. It's something that's a fascinating way for people to take a break. And this is a business that's capitalising on that kind of opportunity.
Got it. Now, we were just having a good conversation about fixed income with the folks at Bond Advisor. In your area of the market, is there an increasing appetite for fixed income type exposures as well?
Generally, fixed income for us, from a public sense, is kind of less exciting, only because the yields are not kind of what we're trying to seek and what our investors are kind of looking for. That said, though, we have increased our focus a little bit on some of the subordinated pieces, particularly where you're talking about very, very high quality lenders such as banks. But looking at some of their sub-debt positions in the public space has taken a bit of our interest. For us, fixed income tends to be a greater risk reward generally in privately offered deals. So that really falls back into private credit, where we can often pick up a bit of a premium for a lower level of liquidity. So we would call that kind of an illiquidity premium, where the asset that we're funding is very, very strong, but because the deal perhaps is not offered in the public market, we can pick that up at a more favourable yield, and the kind of risk reward proposition becomes quite strong.
Mm-hmm. Okay, and so what type of, I mean, this might be too general of a question, but what type of returns do you expect that investors can achieve, if you want to look at as this year as a general rule?
Yeah, I would say in terms of the higher sort of senior positions that we look at in terms of private debt type deals, you're talking about kind of high single digit yields for a senior position to a strong balance sheet type position. Some of those deals will come with full asset-backed security, so that sort of decreases the level of risk in the deal. That said, we are seeing some interesting opportunities that are going into the kind of low teens in terms of yield. So they're kind of you'd say, an equity market type of target return for a debt position, but that debt position needs to be carefully analysed and understood because there is a slightly higher level of risk in the business, but we spend our time really analysing that balance sheet, analysing the opportunity that the business has, and make sure it's at all times it's going on the path that we expect to really decrease any chances of anything going not to our expectation.